Oil prices have been extremely bullish in recent weeks as supply tightens, but with concerns about the future of demand, what's next for oil? Hello and welcome back to our channel. My name is Daniela Hathorn, and in today's video we are going to be doing oil. So we know one of the most traded commodities alongside gold, and one that is highly requested, and definitely one that we've seen a lot of moves in recently, a lot of volatility, a lot of interest. So before we get into this video, please like, comment, subscribe, and turn on your notifications. So as I was saying, oil has been extremely bullish recently. We've seen a strong rally over 10% over the last 3 weeks. Most of this having to do, of course, with the supply side. Now, as we know, Saudi Arabia and Russia have applied a conjoined 1.3 million barrel supply cut in the last few weeks. They have now extended that until the end of 2023. So starting off as that with the base point, we have seen a lot of interest in oil, buying up oil, expecting that these supply cuts are going to continue to keep the price rising. Now, it seems like Russia and Saudi Arabia are working together in kind of a strategic alliance, a little bit of a kind of "we don't need you" rhetoric to the US and to other European exporters. For now, it seems like this momentum has been enough to drive prices higher, but there have been other things going on, and the most recent news that we have is over the end of last week, we did see Russia actually banning exports temporarily from leaving the country. Now, Russia has actually dropped their exports around 30% in the first 2 weeks of September, but now they seem to put a complete ban, temporary ban, on the exports of gasoline and diesel. Now, they are justifying this with the need to sort out their domestic market, stabilize their domestic market before they continue to export to other countries. And we have seen some amendments this morning. They have tweaked this. Originally, it was banning all exports. They have now tweaked that to allow fuel that had already been accepted for exports prior to the ban being announced, that is now going to be allowed to leave the country. But in general, the headline is exports from Russia have been banned. Of course, that puts further pressure on the supply side. And as I said, 1.3 million barrels per day conjoined from Saudi Arabia and Russia already expected to have been cut from the market from now until the end of 2023. That has been extended. And it's expected this is going to worsen the predicted deficit in global supply that's expected over the coming months and heading into the start of 2024. So, of course, again, as I said, putting a lot of pressure on a tight supply. We've also seen the US shale production drop recently, which has meant that US oil has been staying domestically, which again has reduced the exports to, for example, Europe and Asia, reducing the pool that these countries have to bring oil in from. So as I said, a lot of talk about the supply side, reduction in supply, OPEC firmly in there, supporting these reduced supply and these supply cuts on the back of what have been depreciating prices in the last 18 months. Now, it's also important to note what's happening to the demand side. And of course, there are concerns about what's going to happen to economies worldwide, especially as interest rates continue to remain high. Now, last week, we did see the Federal Reserve on Wednesday keep rates on hold, but it was a hawkish pause. We have seen kind of hinting from Jerome Powell that there will be or could be further rate hikes down the line if the data deems so. And a lot of the comments from some of these FOMC members also suggesting that it's very likely that we see further rate rises. But not only that, if we look at the updated dot plot, we do see that now the rate cuts for 2024 have been reduced from 4 to 2. So essentially 50 basis points of cuts have now been priced out from the Federal Reserve for 2024. And of course, that has kept the rate curve elevated. Expectations that the terminal rate, whenever it is reached, will be held in place for a long period of time. It's not expected that we see rate cuts until the latter part of 2024. And of course, that will have an impact on domestic consumption. People have already been feeling the pinch across the globe, not just in the US, but also Europe and the UK and Asia have started to feel the pinch of these higher interest rates and their reduced disposable income. And of course, the ECB and the Bank of England also giving the similar vibes. Bank of England pausing too, a little bit more of a dovish pause for them, even though it's likely that markets don't think they should be doing that. The ECB giving a hike, but a bit of a dovish hike, suggesting that that could be the last one in the hiking cycle. So we do still have very elevated rates. And of course, that is going to weigh on demand. And I think something to note is that rates at some point are going to matter. It feels like right now it's only about determining where the terminal rate's going to be and how long it's going to be held there. But of course, the amount of rate hikes that we've seen, they are going to matter at some point. And if you think about it, if we do start to see rate cuts, it's going to be for one reason. That, of course, is because we're seeing that data start to show signs of weakness. If we haven't already, the debt to GDP ratio in the US around 140% at the moment. That is very, very elevated. And as I say, at some point, all of this has got to catch up to the economy. And there could be signs of trouble up ahead. And a lot of people, especially if you're looking at commodities and oil, they still say, well, with tight supply and demand, it's likely to drop. But we've seen the economy holding much better over 2023 than what we originally forecasted last year. So why would we think now that, worse times are to come? The economy's been resilient, the stock market's been resilient. Well, we have started to see that some of these major indices started to turn lower, but it's sometimes not only what's at the top, looking at what's underneath. And we have seen the likes of the Russell 2000, which is smaller cap stocks, the S&P 500, which is more equally weighted than, for example, the NASDAQ, are starting to show that they are flat on the year and starting to potentially signal a further trouble to come, and the data may start to follow as well, as it is slightly lagged. So there are concerns out there about what's going to happen with demand. And I think with that in mind, that's why we have Saudi Arabia and Russia really pushing for these cuts in supply and trying to keep prices elevated after what they deem to have been a period of deflated prices. Also, something to watch out for is the spread between WTI, so US crude, and Brent crude, which is the European benchmark. We'll look at that in just a second in the chart where we compare the both. But the spread is narrowing. And of course, that discourages foreign buyers from buying US crude. So again, limiting the supply that European countries may have now that Saudi Arabia and Russia are, of course, cutting production, and the US is keeping production to themselves. We'll see in the chart that WTI has advanced a little bit more than Brent. And also we have both of these contracts in backwardation, which essentially means that the front month is more expensive than the latter months. And that, of course, means a tightness of supply. Let's jump onto the chart now to see all of this. Okay, so here we have the chart of US crude, WTI here at the top and Brent crude at the bottom. And as you can see, that strong bullish momentum that's really been taking hold since the end of August. Prior to that, we'd already seen a little bit of a rally, but we did see some consolidation, as you can see on both of these charts. Again, alluding to the sustainability of this rally to push higher. But let's quickly just start with the WTI chart in focus, and then we'll compare both of them. As you can see, the RSI has now ventured pretty much into the overbought territory. That was last week. It's actually the most overbought that it has been since we had that energy crisis and Russia invasion of Ukraine back in the beginning of 2022. In a few instances since then, 3 occasions, we have seen the RSI nearing that overbought territory. The first time that we've actually broken above that 70 line after the February 2022 period was actually in July this year. We quickly corrected that, came back in. But last week actually being the most overbought it has been in around 18 months, as you can see. Now, something to note is that we have seen strong resistance from the highs back here in November last year, October and November. That is essentially where we saw last week's momentum fizzle out. As you can see, of course, the Federal Reserve meeting helping to bring down some of those buyers in oil because of those concerns about demand, and potentially also after a move of this size, we do see a lot of profit taking, traders coming out of their trade, assessing the viability of the trend to continue further. So far, it looks like buyers are struggling to regain some of that momentum. In fact, this morning, after the Russia export ban broke over the weekend, we had seen oil trading higher this morning. So far, seem to have undone some of those gains, as you can see, pretty much unchanged from the open, struggling to really find new buyers to bring it in. As I said, given the amount of moves that we've seen so far already, it's normal to see new buyers slightly hesitant to come in at these levels. Is there going to be further path to go higher? Of course, breaking this resistance, I think, is going to be key psychologically to potentially bring in more buyers. But also the RSI, even though we have dipped back in from the highs last week, we're still again on that overbought level, still seeing that tight market. And again, it's likely that we may see a little bit more of new sellers coming in, potentially trying to take opportunity of a potential sell-off from here. I think the path of least resistance continues to be at the upside. I think there's no denying right now that there is some further room to go. And I think as a seller, there's got to be a lot of risk management in place to make sure you're not caught out on the wrong side of the trade. But of course, for me to be convinced that this has further way to go, I would like to see a little bit of sideways consolidation around these levels. We've already started to see that. And of course, the RSI is retesting those levels. I think we do see a little bit of thought process going into this, and then we see that rally resume, breaking above this key resistance. I think we then got potentially a reason for another leg higher. Of course, fundamentally, we may have some catalysts throughout the week. We may have further reports on the supply side, which we know have been coming in plenty recently. So, of course, that could be the next move higher. But just looking at the prior resistance, which was around $80 and $83 per barrel, we did struggle to break that materially and to really see a move away from there. It took us pretty much a year, which of course doesn't mean it's going to happen again. But we have seen in the past that these key psychological resistance levels are very important for oil traders. And so far, we're continuing to see that, as I said, retesting this November high from last year. So a lot to watch out for there. Similar in Brent crude as well. Similar momentum, breaking away from that resistance and seeing that momentum higher. Now, one thing to point out, as I said, with that spread tightening between WTI and Brent, which actually gives WTI a little bit of head start in that bullish momentum, is that as we've seen, US crude has already hit those highs from November, whereas Brent is still a while away. You can see those highs from November, roughly around the $98.50 mark. We're currently trading around at 92, and the highs from last week at 94. So we still have a bridge of around $4 to close compared to the rally that we've seen in WTI. So of course, this evidencing that tightness in the spread, which favors WTI to continue to push higher. So a little bit of a potential trade there. But as I said, similar in Brent as to US crude, we do still have that momentum pointing upwards, but there is a lot of resistance along the way. As I said, new buyers probably struggling to justify the potential ground to cover still on the upside for the oil market. So that is pretty much it. The rally so far catching up to current levels, potentially a little bit of sideways consolidation, looking to break those key resistances before potentially seeing the next leg higher. That is it for today's analysis. Thank you so much for watching, and don't forget to subscribe to our channel.